Hey everyone, welcome back to Corporate Decoder, where we break down those dense financial filings, and let me tell you, we've got a real treat today. Concentra Group Holdings is showing us how they're navigating the choppy waters of the healthcare market, and spoiler alert, it's a mixed bag of growth and growing pains. Now, if you're interested in understanding the hidden stories within financial reports and want to stay ahead of the curve, make sure you hit that subscribe button and turn on notifications. And hey, for more in-depth discussions and a chance to connect with fellow finance enthusiasts, join our Discord community linked right down below. This is Concentra's quarterly report, giving us a peek under the hood for the period ending June 30, 2025. Think of it as their mid-year checkup. First off, let's talk about the big picture. Concentra is a major player in occupational health services, kind of like the go-to for when your employees get hurt at work or need specific health checks. They've got a massive network, operating hundreds of clinics. Looking at their balance sheet, we see a snapshot of what they own and what they owe. Total assets are at a hefty 2.25. That's a significant jump from 2.55. That's a significant jump from 2.5 billion in tangible assets, which often indicates they've been busy buying other companies. Speaking of which, we'll get to that later. Their current assets, the stuff they can quickly turn into cash, stand at about $395 million at the end of June. That's a bit down from $437 million at the start of the year. On the flip side, their current liabilities, what they owe in the short term, are around $335 million. They have enough current assets to cover these, but that gap is narrowing. Now, let's talk about the elephant in the room, debt. Their long-term debt is substantial, sitting at over $1.6 billion. This is up from around $1.4 billion at the end of 2024, and it's something we'll definitely keep an eye on. On to the income statement, where we see how much money they're making and spending. Revenue for the second quarter of 2025 was around $550 million, a solid increase from $470 million in the same period last year. That's a nearly 15% jump, which is great. For the first 6 months of the year, revenue is over $1 billion, up 11.2% from last year. This growth is largely driven by a higher number of patient visits overall, and importantly, they're getting paid more per visit. For their main business, workers' compensation services, revenue per visit is up about 5.4% to over $28. That's a good sign. And their employer services like physicals and screenings also saw a revenue per visit increase up 3.1% to about $92. This suggests they're either negotiating better rates or their service mix is shifting towards higher paying services. Cost of services exclusive of depreciation and amortization cent. But here's the thing, the cost of providing those services is also rising. Cost of services went up to $389 million in the second quarter, making up about 70.7% of revenue. While that percentage is slightly down from last year, the sheer volume increase means their direct costs are going up significantly in dollar terms, which is natural when you're growing. What's a bit more concerning is the jump in general and administrative costs. These costs, which cover things like corporate staff, marketing and management, shot up to over $52 million in the second quarter, or 9.6% of revenue. That's a big jump from $36 million or 7.7% of revenue last year. They mention acquisition costs for Nova and Pivot on-site innovations, plus costs related to separating from their former parent company, Select. These one-time costs explain some of it, but the increased headcount to operate as a standalone company is a new ongoing reality. Despite rising costs, they managed to increase their operating income to nearly $90 million, up from $83 million last year. So the core business is still generating profit. However, that debt is starting to bite. For the second quarter, they reported interest expense of nearly $28 million. Compare that to just $200,000 of interest income in the same period last year. That's a massive swing thanks to all that new debt they took on, including that $850 million term loan and $650 million senior notes. All this boils down to net income for the quarter of about $46 million. Down from $53 million last year, and net income attributable to the company after accounting for non-controlling interests is down to $44.5 million from $51.7 million. Now, they also present something called adjusted EBITDA, which tries to smooth out one-time expenses. Adjusted EBITDA for the quarter was $115 million, up from $101 million last year. This shows that operational performance, stripping out certain costs, is actually improving. Margin-wise, it's 20.9% this year compared to 21.3% last year, a slight dip but still very strong. Scroll net income attributable to the company said, looking at the 6-month period, net income attributable to the company is $83.4 million, down from $100.6 million last year. The story is consistent there. Revenue is up, but interest expenses and some other costs are eating into the profit. This section shows how the ownership structure changed. At the start of the year, total stockholders' equity was about $280 million. By the end of the second quarter, it's grown to over $347 million. This growth is good and comes from retained earnings and other adjustments. However, they also paid out dividends, about $16 million in total. This is where we track the actual cash moving in and out of the company. For the first 6 months of 2025, they generated almost $100 million from operations. That's down from $115 million last year, largely due to those higher interest payments we talked about. Investing activities consumed a massive $374 million. A huge chunk of that, over $333 million, was for business acquisitions. This includes the big Nova Medical Centers deal and the Pivot On-Site Innovations acquisition. They're clearly in an aggressive growth phase through buying other companies. They also spent about $41 million on property and equipment to grow their facilities. Scroll net cash provided by used in financing activities were a net positive of $164 million for the first half of 2025. This was mainly from taking on new debt, including that $10 million incremental term loan to help fund acquisitions. They also borrowed $85 million on their revolving credit line. However, they also paid down debt, paid dividends, and made distributions, showing a lot of activity in managing their capital structure. Scroll net increase in cash ends. As a result of all this activity, their cash pile took a hit, decreasing by over $109 million in the first 6 months of 2024, which means they used a lot of their cash for these acquisitions and debt management. The notes here are where the really juicy details hide. This section details the Nova acquisition for $265 million and the Pivot On-Site Innovations acquisition for $54.4 million. They're using a mix of debt and cash to buy these businesses, which explains a lot of the movement in their debt and cash balances. The goodwill recognized from these deals is substantial, over $200 million from Nova and $34 million from Pivot. This goodwill represents the premium they paid over the fair value of the identifiable net assets, essentially paying for future growth and synergies. Scroll Lem relationship with Select important to remember. They used to be part of Select Medical. While they are now independent, they still have transition services agreements, meaning Select is still providing some services for a fee. These fees are relatively small, a few $1 million each quarter, but it shows the lingering ties. Scroll 12, commitments and contingencies, and this is where they disclose potential risks and liabilities. They mention various legal actions, including wage and hour class action lawsuits and data breach litigation from a vendor. Specifically, they are dealing with the Perry Johnson and Associates data breach, which potentially impacted millions of patients. While they don't believe it will be material, these lawsuits are a significant ongoing concern. They also mention an ongoing investigation by the California Department of Insurance. Scroll physical therapy billing fent. There's also mention of a DOJ investigation related to physical therapy billing practices. While Select Medical is the primary focus, Concentra is also involved. This investigation has been going on for a while and it's still an open issue. Scroll 13. Segment information send. Concentra organizes its business into 3 main areas: occupational health centers, on-site health clinics, and other businesses. However, for reporting purposes, they aggregate these into a single reportable segment because they are similar in how they operate. The number of patient visits is growing across the board. In the second quarter, total visits were over 3.5 million, up 9.5% from last year. This visitor growth is the engine driving their revenue increase. Scroll to management. Steered discussion and analysis of financial Dean and results of Accession. This is the company's own commentary on their performance. Scroll revenue increased 15.2% to $550.8 million, and they reiterate the strong revenue growth, attributing it to increased patient visits and higher revenue per visit, plus the recent acquisitions. Scroll, our total patient visits increased 9.5% to 3,520. This confirms the strong visitor growth, which is a positive for operational momentum. Scroll general and administrative expenses were $52.9 million, or 9.6% of revenue cent. They again highlight the increase in G&A as a percentage of revenue, continuing to point to acquisition and separation costs as the main culprits. Scrolling 3, quantitative and qualitative disclosures about market risk there. Here they talk about how they manage financial risks, particularly interest rate fluctuations. Scroll at June 30, 2025, each 0.25% increase in market interest rates will impact the annual interest expense on our variable rate debt by $1.6 million per year, Center said. This is a crucial risk disclosure. It tells us that if interest rates go up by just 0.25%, their annual interest costs will increase by $1 to $6 million. Given their large debt load, this sensitivity is significant. They are using derivatives like swaps and collars to try and manage this, but it's a constant balancing act too. Now let's put on our Warren Buffett hat and look at the whole picture. Concentra is clearly in a high growth acquisition heavy mode. Their revenue and patient visits are improving, showing the core business is healthy and expanding. The acquisition strategy, adding Nova and Pivot on-site innovations, significantly boost their footprint, especially in on-site clinics. However, this growth comes at a price. Their debt levels have increased substantially, and so have their interest expenses, which are clearly impacting their net income. The rise in general and administrative costs, while partly due to one-time events, also suggests an increased operating expense base as they go it alone. The key takeaway is that while the top line growth is impressive, investors need to watch how effectively they manage their increased debt burden and control those expanding operating costs. Their ability to integrate the new acquisitions smoothly and continue driving patient visits and revenue per visit will be critical. The legal and regulatory risks mentioned, particularly the data breach litigation, are also factors to monitor closely. Overall, Concentra is a company making big moves, but they're also taking on significant financial and operational challenges. It's a story of ambitious expansion met with the realities of higher debt and increased operating complexity. Alright, that's our deep dive into Concentra Group Holdings' latest filing. What are your thoughts on their aggressive growth strategy and the impact of their rising debt? Let us know in the comments below. If you found this breakdown helpful, give us a like. And don't forget to subscribe for more, and seriously, join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.